It's important to understand the differences between profitability and cash flow. There are things that are profitable and don't cash flow. There are things that cash flow and are not profitable. And we have to understand the difference between the two.
Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business.
Thanks for joining us today. I'm Paul Dietmann. I'm with Compeer Financial. I work in our Emerging Markets Loan Program, which is a loan program for farmers who market their products directly to consumers or do something with value-added agriculture. And I'm based in Compeer's Prairie du Sac, Wisconsin office. Live here in Prairie du Sac as well. Maybe to give you a little of my background, I've been with the Farm Credit System for 12 years. I was with Badgerland Financial prior to the merger that created Compeer Financial. Been a loan officer pretty much that whole time. I worked a lot with our beginning farmer program at Badgerland Financial and also here at Compeer. Prior to joining the Farm Credit System, I was director of the Wisconsin Farm Center for 5 years, which is the Farmers Assistance Program at the State Department of Agriculture. We did a lot of farm transfer work there, did a lot of help with beginning farmers, helping them write business plans, that sort of thing. Before being at the Farm Center, I was a county extension agent, county agricultural agent here in Sauk County for a number of years. Prior to that, did a lot of work with farm transfers as well. I still do some farm transfer work at Compeer, not quite as much as I did in my two previous positions, but I still love doing that type of work. And I'm always kind of keeping my ear to the ground to figure out what people are doing to transfer assets to the next generation, and especially creative ideas to do that. As interest rates were going up, land values have gotten higher and higher. It becomes a bit more challenging to affect a farm transfer. So we're going to go through some examples here today, a number of different stories of things that people are doing kind of creatively to create access for those farm assets. So some of the current challenges, as I mentioned, farmland values really have become disconnected from ag production value. If you look at what land is selling for, what its productive capacity is, what sort of profitability and cash flow you can generate, land values have really, really become disconnected from the agricultural production value. We had record U.S. net farm income in 2021 and 2022. If you look back the last 50 years, in terms of net farm income, overall profitability, and this is nationwide. If you look at the 4 best years out of the last 50 years, 2 of the 4 best years were 2021 and 2022. It's unheard of to have 2 really great years like that back to back, but we did. And so that, I think, pushed land values to a certain extent because we had farmers that had more money available than they had had for a while. So neighbor's farm comes up for sale, you're going to jump on it and try to buy it, even though land values have gone up so much. We've also had a fair number of non-farm investors that have come into the market too. It seems like maybe that's tempered a little bit now, but I think non-farm investors were looking at land values that were going up at double-digit rates of inflation each year, and they saw it as an investment opportunity and they jumped in. So those two things are making it a lot more difficult for a younger beginning farmer to get a toehold and to buy some land. I think that beginning farmers sort of feel pushed a little bit because it's so expensive to get into farming or to start owning agricultural assets. But then I think there's a bit of a pulling people out of agriculture because there are good non-farm jobs available. So back in the old days, it used to be relatively common that if you had the next generation coming back to the farm, you bought more land, you put up a new freestall barn, added cows, maybe you built a new milking parlor or something. So you just expanded the scope of the operation to provide enough, or the scale of the operation, I should say, to bring in that next generation and find enough cash flow to support another family in the farm operation. That's become a lot more difficult now, and we're seeing people looking more at expanding the scope of their operations as opposed to the scale of their operations. The next generation comes in, maybe they look at direct marketing some beef, or maybe they look at leasing land rather than owning land, or they might be transitioning some acres to organic production or something else to generate more cash flow to find a way to fit into the operation. All right, so how are younger farmers gaining affordable access to farm assets? And you'll notice I use the term access to farm assets rather than ownership of farm assets. Some of the examples we'll go through are transitioning ownership. Some are just giving the younger farmers access to those assets so they can generate some farm income. So this is the first example I'm going to talk about. This is a retiring farmer who didn't have any next generation farmers, anybody in his family that were ready to take over the farm that lived nearby. This is a guy who's a good friend of mine. He was farming in North Carolina for many years, but he owned almost no land. In fact, he didn't buy his first land down there until he'd been there for probably 15 or 20 years. And when he did finally buy some land, he only bought 40 acres that had a grain setup on it. So grain storage, grain lag, a scale, a machine shed, and that was it. There wasn't even a house on the property. He was farming about 3,000 acres, though, at his peak. He ended up down in that area. He went to work for a large insurance company. The insurance company had bankrolled someone in that area in the 70s. That person ended up going bankrupt. The insurance company ended up owning thousands and thousands of acres of land in North Carolina, and then they hired farm managers to come in and manage the land for them. My friend went down there as a farm manager, ultimately ended up buying a little bit of land. The life insurance company ended up selling off all the property, and he was leasing from the new owners. So he had a pretty extensive line of machinery. He's a good mechanic. He was really good on the marketing side of things. So he kept his machinery very meticulously. When he decided to retire, he owned several $1 million worth of machinery. It was all paid for. It was all fully depreciated. But he didn't have any children close by that were going to take over his enterprise. So he looked at a lot of different ways of trying to transfer these assets to his kids. He has 2 daughters that are farming, but they both farm more than 1,000 miles from North Carolina. So it wasn't an easy fix to just take that equipment and move it over to his daughters. What he ended up doing was he ended up selling all of his machinery. Well, if you sold machinery, if it's fully depreciated, when you sell it, you have to pay income taxes on the depreciation recapture. And it's at regular income tax rates. It's not capital gains. So he ended up paying ordinary income taxes on all of that depreciation recapture. It was a big bill. He turned around and used the remaining sale proceeds. He built a grain storage facility for one daughter, and then he built hog buildings for the other daughter. He owns those buildings. So he built those. They're using those facilities. He still owns the facilities. The daughters are renting them from him. When he passes away, the daughters are going to inherit those facilities. The way that this ends up working for him, because he's getting the income as rental income, it's free from self-employment tax. So there's an advantage to him in that respect. He's also depreciating the facilities. So he's able to take the depreciation on those facilities during his retirement. And then when the daughters inherit those facilities, the basis in the facilities will step up at the time of death, and they'll be able to depreciate those facilities all over again. So it turned out to be a really good solution in their situation. Okay, the next situation I want to talk about, this is one I worked on last year. It was quite an extensive process. I don't know how many different meetings we had to work out this arrangement, but it was a dairy farmer who was not married, has never been married, doesn't have children. He's got siblings, but the siblings are not close by. They're not engaged in the farm enterprise at all. They don't have children that are interested in the farm. And so this was really a pretty much terminal operation. This gentleman really had no heir apparent anywhere in the family. He was experiencing some pretty significant health issues that were really preventing him from actively operating the farm anymore. The farm consists of 160 cows, milking parlor, a little bit older parlor, freestall barn, full line machinery, 500 plus acres of land, 5 houses on the farm operation on different parcels as part of the farm operation. He had 2 young employees, very young, high school age, when they started working on the farm. As his health deteriorated, these 2 young guys really stepped up, and they're brothers. They stepped up and they essentially took over management of the farm operation while they were still in high school. There are 3 other employees in the farm operation. They live in houses that are owned by the farm, but they weren't really involved in the management. They were strictly labor on the farm. So here's what they ended up doing. The young guys ended up purchasing the cows, and they purchased a very minimal amount of machinery, just the absolute bare minimum that they needed to own. The seller financed these purchases. So it's seller financing for the cows, seller financing for the machinery. They have promissory notes for those items. They worked out an arrangement, or I should say we worked out an arrangement during the course of all the meetings that we had for the seller, the older generation farmer, to buy the heifer calves at birth. And then he turns around and sells springers to the young guys, when they're ready to take those cows into the milking string. The young guys are running the cropping acres, even though he owns the land. They didn't purchase any of the land as part of this transaction. They get paid for working on the crops. They're purchasing the feed. So he owns the feed. He's selling it to the young guys. They're purchasing the feed monthly, and they're purchasing it on a percentage of the milk check. And this is something over the years when I've worked on farm transfers with dairy farm families, this thing that sometimes trips up the younger generation when they negotiate a price for feed ahead of time. They might negotiate a price per ton of haylage, per ton of corn silage, that sort of thing. They either have to get a line of credit in order to purchase the feed, or they purchase as they go. And then, the milk price drops or something like that. And suddenly they're upside down and they can't afford to cover their operating expenses anymore. So we negotiated a monthly feed purchase as a percentage of the milk check. So he's getting a milk check assignment that covers the feed that they're using. The other employees are not working for the young guys. They're still working for the farm owner. And the young guys are paying a rental fee for the facilities and pay a bit extra to cover the cost of those workers and what they do in the dairy operation. The young guys also have options to purchase the dairy facilities and just the parcel of land that the dairy facilities sit on. They have an option to purchase other machinery, and they have an option to purchase the rest of the land when they're ready to do so. So they've got a long-term lease on the facilities. They own the cows. They own some machinery. They can purchase more machinery, and eventually they can own the real estate too when the time comes, once they've got some equity built up in the first few items that they purchased. So it's kind of a complicated situation. It was multiple agreements that had to be signed ultimately, but it's been in place for more than a year. It's working really well. Even last year when milk price was relatively low and feed price went up, and we ended up, after about 2 months, we went back to the table and renegotiated the arrangement because it turned out to be a little bit unfair to the owner of the farm. And the young guys recognized that. And at their instigation, we renegotiated the deal to make sure there was more cash flow coming through to the older generation farmer. Okay, so the next one is a non-farm investor who was interested in helping a young organic farmer. This is an older person, ethics-driven investor, a retirement investor. This isn't a wealthy person, but this is someone who's been saving her whole career for retirement. And she was very specific in not wanting her retirement funds invested in certain industries or with certain companies. She's a very, very ethics motivated person. There was at the same time a young organic farmer who was looking for an opportunity to lease land, but wanted a lease to own arrangement. So he didn't want to just lease land forever. He wanted to be able to eventually own the land. These two happened to serve on a board together and got to know each other. The older person, she was still working at the time. She's now retired, but at the time she was working, and she was at a board meeting with this younger guy, and they had a conversation. She was explaining what she was thinking about. She went to her financial advisor. The financial advisor said, well, we can put you into like a socially conscious investment fund. The returns are a little bit lower. We're going to take 1% of your portfolio each year for managing it. And she was doing the numbers, and she just didn't feel like it was really worth her while to do it that way. But she still was looking for a way to invest her funds that matched more with her personal beliefs. And she had roughly $500,000 saved in a 401k. So about $500,000 available to invest. So after getting together and talking about this, what she ended up doing was creating a self-directed IRA. So you can take your investment funds, you can put them into a self-directed IRA. Self-directed IRA gives you ability to invest in a lot of different things that you wouldn't be able to invest in a traditional IRA or traditional 401k program. So she created this self-directed IRA. The young farmer found a parcel of land that fit the investor's budget. So fit in that $500,000 budget. So he found a piece of land relatively close to where he lived, matched up with what he needed. The investor bought the land. She turned around and she rents it to the young farmer. And then he's going to buy undivided interests in that parcel of land over the course of 25 years. And it's a set schedule. So every 5 years, he buys an undivided interest in this parcel of land. It's 40 acres. He pays a base rent every year. The base rent covers the property taxes. And then there's also a variable rent that's paid. A portion of the variable rent gets paid to the investor in cash. The rest of that variable rent goes into a fund, and that fund is used to cover this younger person's down payment on the property. So it's been a really good arrangement for the two of them. The investor is actually getting a pretty decent rate of return. I ran the numbers for them. The internal rate of return that she's getting on this investment of farmland, it's been about 5.5%. And the investment's been in place for about 10 years now. So her internal rate of return, about 5.5%, like you say, that lags the stock market. The stock market over that same period of time was up about 8% or so. But her goal when she went into this investment was that she wanted to beat the rate of inflation. And the average rate of inflation over the last 10 years has been about 2.8%. It's been high lately, or the last couple of years. But over the course of the last 10 years, it's actually been significantly less than that. So about 2.8. So she's more than doubling what her goal was, which was to beat the rate of inflation. But it's worked really well in their situation. She likes the fact that there is a personal relationship there. Like she can go and she can look at the farm. She can see what she's invested in, and she knows she's doing something good with her money. So I'll just talk a little bit more about self-directed IRAs. With the self-directed IRA, you can hold alternative investments that would be prohibited in a regular IRA. So farmland, for example, there are potentially more fees. So it depends on who your custodian is, but you could end up paying more fees. In their case, the fees were less than she would have paid if she'd paid 1% for someone to actively manage, socially conscious investment fund. The funds are controlled by the investor, but it has to be administered through an SDIRA custodian. And those custodians can be a little bit difficult to find. There aren't a lot of them around. The custodian can't provide any advice to the investor. They only handle the funds. The investor has to direct which direction the funds are going. They can't ask for advice from that custodian. The custodian has to be hands-off, just a pass-through for the money to make sure that the rules are being followed. There are really strict rules on self-dealing under a self-directed IRA. So, for example, an investor couldn't sell real estate that they own into a self-directed IRA. That would be considered self-dealing. So if they own a piece of land and it's outside of an IRA and they want to put it into a self-directed IRA, that's not allowed. They can go out and buy land and put it into a self-directed IRA, but they can't transfer land in. An investor can't manage or use the real estate in a self-directed IRA. I have a good friend who owns some rental property in a self-directed IRA. And this is a guy, he's actually a handyman by trade, but he can't go in and change a light bulb in the building that he owns. He has to hire somebody to come in and do it. If he did it himself, it would be considered self-dealing and he'd be in violation of the rules and could risk a pretty significant penalty. So you can't actively manage, you can't use the real estate. Like in this case, Mary couldn't farm it herself. It has to be farmed by Wyatt or someone else. You can't borrow from your self-directed IRA, so you can't take a loan out of your self-directed IRA. And then it's difficult to borrow for an SDIRA to purchase real estate. Any loan that is taken by a self-directed IRA has to be non-recourse. And also because there is no self-dealing and there has to be sort of an arm's length transaction, the investor wouldn't be able to personally sign on a loan that's made to an investment in the self-directed IRA. So there's another pretty significant restriction that makes it really difficult to borrow if you're going to buy real estate in an SDIRA. You almost have to be an older generation investor to do this. But it's another option in some cases. So I just wanted to share that with you. Next situation is a nonprofit organization that's dedicated to preserving land that's under development pressure. So this organization is called the Conservation Fund. They have an office in Chicago. They have an office in Atlanta. They're a national organization. They're really working to preserve working farmlands that are under development pressure in the outskirts of Chicago. So they've been looking at purchasing land in the collar counties around Chicago or even in Cook County, but outside of the city limits of Chicago. because land in that area is very expensive, the parcels that they've been buying are relatively small and they're relatively expensive. So they have the funding to go out and buy land. I think they've purchased maybe 5 or 6 farms at this point. They're seeing that there's a growing number of first generation farmers that are selling into the city that need land in close proximity to the city. And these are folks, a lot of cases, that we're financing under the Emerging Markets program. They're folks they didn't grow up on a farm. They don't come from a farm background. They don't have that support of a family farming operation behind them. They're starting out on their own, and they're starting out very low equity, a lot of energy, good ideas. They generally are good farmers. They have good markets in the city, but they lack access to land, at least land that's close by, enough land to grow at the scale that they need to grow to make a living. So the Conservation Fund created what they call the Working Farms Fund, and they use what's known as a buy, protect, sell model. So they buy these farms on the outskirts of Chicago. They put in a conservation easement on the farm, but it can take a little while to set up that conservation easement. Sometimes it'll take 2-3 years to get a conservation easement in place. So they're purchasing the farm. They're leasing the farm to a beginning farmer. They lease the farm under pretty favorable terms to the beginning farmer. They'll even do some infrastructure improvements and things like that. And then they work out a deal to sell the farm to the beginning farmer at a reduced value, because they take off the value of the conservation easement and then sell it to them at the remaining value. The Working Farms Fund is in the process of selling its first farm to one of its farmers, and will probably end up financing that purchase jointly with the USDA Farm Service Agency. So I'm really intrigued by this model. It's a nonprofit organization that's really dedicated to preserving working farmland in the Chicago area, in Atlanta and other parts of the country, but I'm focused specifically on what they're doing within our territory and helping set up beginning farmers for success, selling in the farm when it makes sense from a cash flow perspective to purchase that farm. This next one is a conservation district in Illinois. They've got a lot of land to maintain. Some of it is farmland. Some of it is rented out as cropland. Some's rented out as pasture. They're managing a lot of land, like 25,000 acres of land. Some of it is owned by the conservation district. Some of it, they have conservation easements. Some of it, they have arrangements with private owners to manage the property for them. So they've got all of this land, and it's expensive to maintain this land. The goals of the organization of the McHenry County Conservation District, the goals are, number one, to provide wildlife habitat preservation, but number two, to provide educational and recreational opportunities for the public. They don't want to just put a fence around this land and then lock it away from the public. They want to make sure that the public has access to the land while they're managing it for wildlife. At the same time, there was a bison ranch that was looking for more land to graze. Land is very expensive to purchase, obviously, especially to use it as pasture. The infrastructure needs for bison are more significant than they are for any other species of livestock. It's very specialized types of infrastructure, the type of fencing that you need, the handling facilities you need, and all that sort of stuff is really expensive. So it's really cost prohibitive to try to do this in a typical pasture lease situation. So these two got together and they ended up entering into a 15-year lease arrangement to put bison on 180 acres of land that's under management by the McHenry County Conservation District. It's a very advantageous lease for the bison producers. It gives them the ability to put in the infrastructure. The lease is relatively low in the early years while they're investing in the infrastructure, the fencing, and the handling systems and other things that they need to maintain bison on this property. And then it increases, but it's still I would say, a very reasonable rental rate for the property for the whole 15 years. Having that 15-year lease in place makes it doable to make that sort of capital investment in the fencing and the handling facilities and stuff, and to be able to recoup that investment from having the bison out there for 15 years. The first couple of years, they've restricted public access, mainly just out of some public safety concerns, some concerns for spooking the bison. They want to kind of ease into it, but eventually the public will have the opportunity to see the bison in this habitat. And so it's been a really advantageous arrangement for both sides. Bison were the species that predominantly grazed in the upper Midwest hundreds of years ago, including in Illinois. And so it's returning bison to the land. It's preserving bird grassland habitat So they're rotating the bison through the system, which is keeping the grassland habitat in place for long enough for the birds' mating season, things like that. So it's been a really great arrangement. I'm particularly struck by this sort of thing because there is a lot of public land, and this public land that could be used for agricultural purposes and can be a real win-win situation like this is. This next one is a relatively similar situation, but it's in a different part of the country. This is in Ohio. It's the Cuyahoga Valley National Park. The Cuyahoga Valley National Park was formed in 1975. Before the national park designation was put in place, area residents were fighting to preserve historic buildings in the area. It was an area that people had kind of left over the years. There was a proposal to build an interstate highway through the middle of the Cuyahoga Valley, and folks are really concerned that it was the construction of the highway system was going to end up causing them to destroy a lot of historic buildings in the area. So people got together. They wanted to preserve the buildings and preserve the history of the area, but they didn't want to just restore and preserve these buildings. They also wanted to make these buildings usable, and they wanted to make sure they were being used. In 1999, there was a group, kind of a subgroup that formed in the area to preserve the working farmsteads that were located within the Cuyahoga Valley. And they did an inventory back in 99. They found 85 remaining farmsteads within the park itself. Of those 85, they figured only about 24 really had the potential for restoration. The rest were really too far gone to try to bring them back to life. So they identified 24 that had the potential for restoration. They ultimately ended up restoring, I believe, about 14 or 15 farmsteads. The way that I even heard about this in the first place was a good friend of mine was living in Ohio. One of these farmsteads came up for rent, and it's when they put them up for rent, the person has to agree to actively farm these farmsteads. They can't just rent them and live there and go work someplace else. They actually have to operate those as farms. So this friend of mine was considering putting in a bid for renting one of these facilities, and I had helped him put together a lot of numbers and put together his business plan and his lease proposal, which ultimately wasn't accepted. And I think not only not accepted by the park, but I think his spouse wasn't all that enthused about the idea of farming in the middle of the national park. But I was really intrigued by the model. I thought it was great that they're taking these farmsteads and making it available to people. So this Countryside Initiative, which is the group that started in 1999 within the Cuyahoga Valley National Park, right now there are 9 restored and operating farms. Like I say, I think they restored about 14 or 15. They actually have 9 that are being rented and operated at this point. The people leasing these farms have very long-term leases from the National Park Service, so up to 60-year leases with the National Park Service. And there is a mechanism in there if for whatever reason these people aren't interested in farming anymore, don't want to farm anymore, that they can transition that lease to someone else. But they do have that lease in place theoretically for 60 years, which allows them to make their own infrastructure investments. They could put up buildings or things like that. It's a competitive process when these farms come available. So you have to put together a business plan. You have to explain what you're going to do, what you're going to raise, how you're going to farm, and how you're going to market the products that you're farming. It's a pretty involved process. The focus really is on diverse and sustainable operations. So they want people who are going to be growing things that are most likely being sold directly to consumers. There's a lot of tourists that come through the area. And so it's kind of a synergistic relationship in that respect. So just another idea of using public land and making it accessible, giving access to farm assets to younger farmers. So other ways to facilitate access to farm assets. We do a lot of partnerships with the USDA Farm Service Agency. FSA does direct loans. They do loan guarantees to lenders like Compeer. We do a lot of joint financing arrangements. I do a lot of beginning farmer down payment loan program loan facilities with the FSA. So we've had great success working with this program. FSA is great to work with. We partner, like I say, it isn't just they take their application, we take our application. A lot of times we're going out and doing a joint farm visit. We're gathering the application at the same time so that the farmer doesn't have to submit applications 2 different directions. We're helping them put their cash flow projections together and things like that. So that's been a really great way to help farmers access farm assets. The only criticism I would have, and it's not a criticism of FSA, is that their lending limits haven't increased in years, and they really need to keep up with the increase in asset values. There are a number of grants available that can be used creatively to help beginning farmers access farm assets or make better use of farm assets. A couple of these are through the Natural Resources Conservation Service, and that's the EQIP grant and the RCPP grant. EQIP is Environmental Quality Improvement Program. RCPP is Regional Conservation Partnership Program, sort of a subset of the EQIP program in very targeted areas. There are other grants. The Sustainable Agriculture Research and Education Program has farmer and rancher grants available, and there are other grants available too. Grants are sort of the icing on the cake. They aren't the cake. You still have to have a good business plan. You still have to have a solid working farm, but grants can be a little kicker to help with certain things. Another way to access farm assets that we use within Compeer is our tax lease program. I've been using the tax lease program more and more the last few years, especially for construction of buildings. Our tax lease program, it can be used for buildings, it can be used for equipment, it can be used for vehicles. The way that the program works, if someone wants to put up a new building, well, let me talk more about how a traditional construction loan would work. If someone wanted to put up a building, typical construction loan, this is one of my clients. It's an Amish machine shop. This is a guy, we didn't have a mortgage on the property. The property was mortgaged with another lender. He wanted to put up this new shop. He went to his lender. Cost of construction was going to be about $200,000. The lender said, okay, well, we're going to do what's called an as-will-be appraisal. So we appraise the building as it will be when it's completed. The as-will-be appraisal came back. It was $150,000. And that's pretty typical that the as-will-be value will be about 70% of the cost of construction or 75% of the cost of construction. So the value of the building as will be $150,000. The lender said, we'll loan you 70% of that as will be appraised value. So 70% of $150,000, $105,000 will loan you to put up this $200,000 building. This gentleman called me and he explained the scenario and he said, is that typical? Is that really how it goes? He said, I saved something for a down payment. I didn't save $95,000 for a down payment. So I'm thinking about how I can take things out of the building and cheapen it up. But if I take too much out, then I'm going to lose business. And he was really in a tailspin. I said, yeah, that's typical. If we were going to do a construction loan, we'd do it pretty much the same way. But we have this tax lease program. Under the tax lease, the building costs $200,000. We'll help you. We'll put up the building for $200,000, and then we'll lease it to you. So Compeer owns the building while the lease is in place. We lease it to the user, in this case, the machine shop. There's no down payment required because we're the ones building the building. We own the building. There are no payments on the tax lease until the building's put into service. There's no as-will-be appraisal because, again, we own the building. We're not doing a construction loan on it. There's no mortgage. So there's a mortgage. He has a mortgage with a local lender. We're not putting a mortgage on the farm. We're taking what's, basically just a fixture filing, UCC filing, like we would with a tractor or any other piece of equipment. So we do the UCC filing. The typical structure on a lease like this is a 12-year lease. We take that $200,000. We take 15% of that. We set that aside as a residual. I kind of think of it as making the down payment at the end of the lease term instead of at the beginning of the lease term. We take the remaining 70%. We spread it over 12 years. We apply an interest rate to it. And that's what the lease payment is. It's a true tax lease, so the person can write that lease off, the lease payments off as rent on their taxes each year. But they are building some equity in the building. By the end of that 12-year lease term, my client will have paid 85% of the cost of the building. They'll pay the last 15%. They own the building. We release our lien on it. We don't call it principal. We call it a net investment that they're accruing within that building. So they're building some equity. Leases are convertible. So if interest rates go down, we can convert to a lower interest rate. If at some point he decides he'd rather have a loan than a lease, he can convert it to a loan, whether it's with us or with the bank. It gives us a lot of flexibility, and it's just a much simpler process than that construction loan process. So again, it's a way. We've done buildings like this. I've done I've done 3 egg laying facilities for younger farmers where they wouldn't have had a down payment to put up the building, but we can do it under the tax lease program, gets them into production, and then at some point they'll be able to buy that building out, and away they go. Just got a few final thoughts that I want to discuss. When I start working on a farm transfer, I always start by considering the young farmer's finances first. Like I mentioned, the two young guys and the dairy farmer who didn't have any heirs. I did talk to the older farmer when he was having health issues and he was trying to figure out what to do with the farm. And he mentioned that these two young guys had a real interest in taking it over. And then I started meeting with them, helping them put their finances together, balance sheets, cash flow projections, enterprise budgets, trying to figure out what is the most they could possibly afford to pay and make this a going concern. And they couldn't obviously take on 500 acres of land and a bunch of buildings and 5 houses and try to cash flow that entire thing. But they could bite off chunks of it. They could buy cows and they can make the payments on the cows, lease the rest of the facilities, and slowly start building into ownership of the rest. But we usually try to start by considering the young farmers' finances and figure out what's the most they can afford to pay. But it still has to work for both generations. It isn't right that you work your whole life and then you give everything away at the end. You have to, and most farmers, the majority of their retirement is tied up in their farm assets. So it's reasonable that they get something close to fair market value if at all possible. So the arrangement really has to work for both generations or nobody's going to be happy and it's never going to work. It's important to understand the differences between profitability and cash flow. There are things that are profitable and don't cash flow. There are things that cash flow and are not profitable. And we have to understand the difference between the two. The example of something that's profitable but doesn't cash flow, I think of like starting a beef cow herd. So if you start a beef cow herd, you're going out, you're buying cows, you're buying feed, you're renting pasture, maybe you're building fence. You got a bunch of cash going out. You have no cash coming in. But those cows start having calves. And by the end of the year, you put your balance sheet together and you've got a bunch more animals than you had at the beginning of the year. You may not have generated any cash flow. You may not generate cash flow for 2 years before those calves are ready to sell, but you created something of value on the farm. You had expenses tied up in order to create that something of value. We calculate profitability, rate of return on assets, rate of return on equity. That operation might have been profitable, even though the cash flow was very negative. On the other hand, we have farms that cash flow and are unprofitable. We have a lot of farms like this. There are people who have been farming for a long, long time. All their debt is paid off. The kids are grown. They're out of the house. Family living cost is low. The farm is doing just fine. They're cash flowing with no problem at all. But if you looked at the rate of return on assets, rate of return on equity that's tied up in that farm operation, the farm may not be profitable, maybe highly unprofitable. And then you try to sell it to the next generation at fair market value, and it just will never work. That's why we see so many farm assets that transfer at less than market value. It's important to understand the difference between these two things, profitability and cash flow, and look at these arrangements from both perspectives. We often have to find ways to add cash flow to the farm operation for bringing in another generation without making big capital purchases and without taking on additional debt. And so that's when I mentioned earlier, we're seeing more of the next generation coming in that are doing things like direct marketing meat or maintaining more off-farm income than maybe they would have done in the past. They have to find ways to add cash flow if they're going to join the farm operation without taking on big capital purchases that may drain cash flow or taking on additional debt that creates a cash flow burden that the farm can't handle. We're seeing more outside investors coming into agriculture, and that sometimes can be a good thing and sometimes can be a bad thing. I encourage people to be very cautious when considering outside investors, but it might be worth taking a look too. I just recently had one of my clients, and I work in a very specialized area of agriculture, value-added agriculture. I've got a business that started like 2 years ago. It's growing very rapidly, but the cash flow isn't quite keeping up. We just extended their line of credit a bit more, but there's kind of a limit on how much I was comfortable extending. And they had an opportunity to bring in an outside investor to take a very minority equity position in their business. And it was really advantageous to them. It helped their balance sheet, provided them with some needed cash without creating additional loan payments. So bringing on outside investors can be okay, but you want to be really cautious about who you take on and what the arrangement is, how much control they have over your operation, that sort of thing. I encourage young farmers to learn how to calculate internal rate of return. I mentioned the SDIRA example and that I calculated the internal rate of return for Mary for her investment in that farm, and it ended up being about 5.5%. I've been really, really preaching about internal rate of return for the last 5 or 10 years. trying to encourage young farmers to learn how to calculate internal rate of return. It's such a powerful tool, especially when you have a very limited amount of cash to invest in anything. If you're looking at investing in land versus investing in a beef cow herd, you want to look at the internal rate of return of those two things. And right now, with land values the way they are and what that would do to your cash flow as a young farmer to take on a land purchase, the internal rate of return might be 3% if you paid cash. It might be negative 15% if you take on debt to make that purchase. On the other hand, you might invest in a beef cow herd and the internal rate of return could be 10, 15%. Or you take on rented pasture, and if you have it rented for a long period of time, like the bison ranch example that I mentioned before, you could make that infrastructure investment. And even if at the end of 15 years, they walk away from that fence and that handling facility that they built, they would have gotten their return out of cash flow over that 15 years. The internal rate of return on that initial investment might be 30%. You put an EQIP grant on it and it could go up to 70%. So it's a really, really powerful tool to generate wealth over a long period of time. And if you don't understand it, you make the wrong investment early in your farming career, you're going to be on a treadmill you're going to be on for the rest of your life. And that's what I have for you. So thank you all for joining us today. And thanks again for tuning in and for paying attention. I really appreciate it.
Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit Compeer.com. That's COMPEER.com. Until next time.